Hey there, everyone. Dave Keller here with Market Misbehavior. I'm the President and Chief Strategist of Sierra Alpha Research, and I'm so thankful that you're joining me here on my weekly show on StockCharts TV. You know, no denying the fact that I think the markets are experiencing a major league change of character in early 2025. We've been documenting this on our market recap show called Chart This with Dave Keller. In a lot of my podcast interviews called the Market Misbehavior Podcast with some top market practitioners has often in the last 6 weeks focused on potential signs of changing configuration, right? The bull market, the great bull phase of 2024 starting to show signs of change. And we've seen that change in a number of different places. Last week on my weekly show on this channel, we talked about what I call the 3 signs of the bear, looking at deterioration in breadth, looking at deterioration in momentum signals, right? What we call bearish momentum divergences as markets go higher, as prices go higher on weaker momentum readings. And we've been observing that clearly in Q1 of 2025. Weaker breadth conditions with a lot of the major breadth indicators sloping downwards. We'll touch on that a little bit on this week's show as well. Bearish momentum divergences as prices go higher on weaker momentum readings, where the RSI is sloping downwards while the price is going higher. And we saw that first with NVIDIA going into this year, but now have seen it on a ton of different charts, from Alphabet to Synchrony Financial to a bunch of other things as well. So where does that leave us? I would say, this week what we're going to talk about is what I call the line in the sand technique. I often get a question as I've been sort of surfacing some of these concerning patterns that I'm seeing, some of these patterns very similar to previous market tops. Question is like, what's next? And how do you know that things are really starting to deteriorate? The line in the sand technique is sort of my general way of keeping it super simple, which may not be surprising if you followed my work. My goal is to simplify as much as possible, but to focus on a particular level, a particular pattern, a particular movement, a trigger that would tell you that what was ever happening before is now different. Because what I've found is some of the worst things you can do, one of the worst things you can do as an investor is hold on to something way too long and sell too late. Has this ever happened where you hold on to something and it's worked so well for you, it starts to roll over, it starts to break down, it continues to go down, it continues to go down, but there you are just holding it. You're holding it, just hoping that it stops going down and hoping that it starts going up again. This is based on a behavioral bias called the endowment bias, which is the subject of a whole separate video, which maybe we'll work up for the channel someday. But for now, basically, how do you prevent climactic loss by holding on to something way too long? And the answer is you need to have a clearly defined exit strategy. And I think the line in the sand technique, which is basically using the chart, using the alert system on StockCharts.com, I think you can you can get out of the way, hopefully very, very quickly. All right, so let's just set the table for our meal we're about to eat together by focusing on what we call, where are we? Here we go. The market trend model. This is a model that I developed years ago, basically defining the market trend on 3 different time frames. And the idea here is we're basically trying to look at the long term, which for me is over a year, the medium term, which is a couple months, and then the short term, which is a couple days to a couple weeks. And so by using a series of weekly exponential moving averages, I can define the trend on each of those 3 different time frames. And I'll include a link in the description below to a recent video that I put out on my YouTube channel. It really goes in a lot more detail than we have time for today, just on the mechanics of this model and why we selected the certain combinations and how to use it in a little more detail. But the short answer is it just turned bearish on the short term for the first time in 2025. It turned bearish a number of times last year, 1, 2, 3, 4, 5 times through the course of 2024. Every one of those times ended up being fairly buyable dips, right? And that's the kicker. That's the challenge as I describe it to people, is the beginning of a waterfall decline and the beginning of a brief, very buyable pullback in a lot of ways look very similar, right? And that's true. So, there's no guarantee based on what we've seen so far that it's going to be a very short decline or a very protracted decline. I think that becomes more clear after a little while. And as a quick comparison, I will show you the big difference for me in terms of how we differentiate a brief pullback to a more significant pullback is in the brief pullbacks, my short-term model turns bearish, which is when the short-term PPO, which is making this comparison here on the weekly data, goes below zero. That's a short-term bearish signal. But the medium-term model remains bullish. That tells us we are in a short-term pullback within a long-term uptrend. When, like the beginning of 2022, we had the short-term model turn bearish, very similar to what we've seen recently, but then very soon after, the medium-term model turned negative. That, for me, is a big red flag because it tells me, okay, it's not just a short-term tactical move. This is more of the cyclical time frame starting to show me that this is more of a deteriorating market, and I probably want to start getting defensive, or at least start to think more defensively. The long-term model for me turned bearish in May of 2022 after the decline was really progressing quite a bit. So the medium-term model for me is my main risk-on and risk-off model as of today. And it's really Tuesday, February 25th. But as of last Friday, which was Friday the 21st, short-term model turned bearish because I do this every Friday at the close. Medium-term model, long-term model still bullish. So for now, this is telling me a short-term pullback, but could turn into something more significant. Now, as we go through the lines in the sand, I want to make sure that you're comfortable with the alerts functionality on StockCharts.com. The great thing about a fully featured technical analysis website like StockCharts is that it comes equipped with scanning to help you identify ideas. It has all sorts of breadth and broad market indicators to help you understand the broad conditions, but it also has alerts so that you don't have to closely follow tens, if not hundreds, of charts every day to see if something triggered. You analyze the chart, you come up with the level that's most important, you set an alert, and then you go worry about something else and let the website tell you when something's going on. So I'm going to take a brief moment and digress and show you how to set up these alerts. Then I'll show you 4 more charts with the particular lines in the sand that I will be setting alerts for as soon as I'm done with this video. So to get to the alerts platform on StockCharts, you can go to the main dashboard or the main page where you find charts and tools. You want to get to this section, which has alerts. These are just the different ways you can monitor your own alerts and then create your own simple price alerts and then advanced alerts based on different technical indicators. And pretty much anything you can scan on, you can set a live alert that will track those signals intraday for the most part on the platform. Other easy way to get there is just click on your name in the upper right corner. That's where you'd set up your account and stuff, and just go to your alerts and it'll get you to the same place. Now, to start off with, I'm going to see the alerts that I've set, and a number of these have already been triggered. I can see that it says paused, which basically means they've already been triggered. But by resorting the list, I can see the ones that are currently running. I can see the ones that are currently engaged and have not yet been triggered. And this is basically looking for key breakdowns in key charts that I've been tracking from some random time. And what's great is you can put a note in, which I'll show you in a moment, to remember what exactly you were looking for. All right, so here we have the S&P 500. It's bringing up a preview chart, and I can see that, again, the preview chart's pretty helpful. I mean, it's just a quick and dirty chart, but it does just remind you what general levels you're thinking about. And here, 5850 is the level we're going to talk about in a moment. So what I basically want to say is tell me when the S&P crosses below 5850 and say, we're breaking down below 5850. And you can put whatever message you want. And again, I would just encourage you to make it a meaningful message, because the more alerts you set, the more you're probably going to remember what exactly was motivating that particular price alert. And then at the bottom, I would encourage you to select all of these. Email means it's literally going to trigger an email. I have within Gmail, I have a rule set up to put all of the StockCharts alerts into one folder, so at any point I can look and review some of the alerts that I've received. Text message, just make sure you have your mobile number updated, and it's literally going to light up your phone if one of these triggers occurs. And then site notification puts a big banner at the top of the website. And I found all 3 of these are helpful. I tend to have them all checked because I think they're pretty meaningful. And at the end, you hit save alert, and it will say your alert was saved. Yay. And then when you go back to your alerts, you should see that one listed on the top. And so the idea is as you add more and more, you can start to manage those and update them if you want, or continue on there. So I just want to make sure you're familiar with that particular functionality, because I would encourage you as we go through these charts to think about what alerts you want to set on the charts that you're following, and make sure that you set them up today. And by the way, if you want to do anything more complicated, like when this breaks its 200-day moving average or when it hits a certain volume threshold or anything like that, you want to use the advanced alerts, which look a lot like the scanning engine because it's built on the same, sort of underlying code. You use all the drop downs and it'll create the code as you go. So use the drop downs, it'll add the information, put the node in there, same as before, and that's how you can get updated. All right, so 4 charts that I will show you now that I would encourage you to set alerts on. I will certainly be doing so as soon as we're done. This one I already set up, which is the S&P breaking my major line in the sand of 5850. What I've been talking about, again, in my own content now for a couple months, is the fact that once we had this upside gap sort of post-election in November, we gapped above 58.50, and that also took us above the October swing high, the previous all-time high that we reached going into the elections of early November. From there, that lower end of that day, that gap day, or the upper end of this price gap, became a pretty significant level of support. And indeed, the whole gap has become an area of support as we go into the beginning of this year. But look at how the pullback in November, late November, mid-November, pulled back to that same point, 58.50. We can see subsequent tests in late December a couple times. Also in early January, we did briefly undercut 58.50, but we held basically this gap and then gapped back higher in mid-January. Now that we're rotating lower off of the most recent all-time high, right around 61.50, I can continue to think that 58.50 is the level to watch. So by setting an alert and saying S&P below 58.50, the moment that happens, it's going to pop up and alert me in all those places. I got an alert earlier today, by the way, because small caps, the IWM, the Russell 2000 ETF, had broken its line in the sand based on what I had set up. And thankfully, I had that alert set up already. So I immediately knew when I sat down and started going through charts, I should focus in on small caps because that's where there was some potential movement. So as a reminder, as we covered in the last video that we posted on StockCharts TV, we've had momentum and breadth deterioration December, January, February. Each one of these new highs has seen the RSI sloping downwards, and that's not encouraging. Particularly this most recent new high about a week ago came with an RSI stalling out around 60, and that's really more of a bearish range for the RSI indicator. As long as we hold 58.50, I think things are okay, but if and when we would break below 58.50, for me, that means I want to engage more of my defensive protocol, start to think about capital preservation, and make sure that I'm focusing on surviving a potential further downdraft in the S&P 500. Now, we can also use this sort of line in the sand technique with other indicators. This is an indicator which I call the newer Dow theory. This is based on, derived from Charles Dow's original work from the early 1900s. He wrote a series of essays where he talked about combining analysis of different major indexes. What he originally wrote about was the Dow Industrials and the Dow Railroads. So the producers of goods and the distributors of goods. And the idea was if both of them are making new highs, that's a bullish confirmation. If one of them makes a new high and the other one does not, so you have a divergence, that's called a bearish non-confirmation. Basically, one of the indexes is not confirming the strength in the other. They are not confirming one another. As a result, that is often the sign of a bull market exhaustion. And his logic of that was, you have the producers of goods and the distributors of goods. Those are like the two main parts of the U.S. economy, and one of them's working and the other one's not. That tells you there's something going on in the system, right? Something going on with consumers, with the supply chain, with something, but there's a mismatch between supply and demand, and as a result, it usually means there's weakness that is not necessarily being reflected in investor behavior, but it probably will be. Now, if you look at the equal-weighted S&P 500 and the equal-weighted NASDAQ 100, which is sort of my modernization of Dow theory, because the Dow Industrials and the Dow Transports, you can follow them. They're not particularly bullish at the moment, mainly because transports have been so weak, but they no longer, I would argue, represent what Charles Dow was really getting at, which is like the two main parts of the economy and what are they doing. By looking at the equal-weighted S&P kind of representing the old economy, the equal-weighted NASDAQ 100 kind of representing the new economy, I think you have a good modern version of what Charles Dow was trying to accomplish with what we now call Dow theory. So from December through January, we can see the equal-weighted NASDAQ 100 has clearly made a new all-time high. The equal-weighted S&P nowhere near doing that. And so we have a bearish non-confirmation. Now, to be clear, they don't always work out as expected. So we also had a bearish non-confirmation around that July-August pullback of last year. It ended up being the most significant drawdown, very close to that spring pullback that we saw for the S&P 500. And the equal-weighted S&P, the equal-weighted NASDAQ pulled back. The equal-weighted S&P made a new high in late August, while the equal-weighted NASDAQ did not. So that felt like, and certainly appeared to be, a bearish non-confirmation. But if you look, we never made a new low. Neither of these undercut their August low. So you never had that bearish confirmation. We just had a bullish non-confirmation. It said the uptrend is probably done, but we never had that confirmation that a new downtrend phase was occurring. And sure enough, a couple weeks later, we actually had a bullish confirmation when both of these once again made new highs. So what you look for in this particular instance is when these break below their swing lows. So you want to look at the January low for the equal-weighted S&P, which is around 173. You want to look at the January low for the equal-weighted NASDAQ, which is around 89.50 or 90. And I would set alerts for those levels. And if you would see breaks of both of these indexes below those January lows, they both make a new low for the year, that would be a big sell signal from newer Dow theory. So that's the second set of alerts, the lines in the sand that I would be monitoring. The third one gets to the subject of our previous video, which is breadth deterioration, right? One of the notable, characteristics of the markets in 2025 is in 2024, you had stronger prices driven by stronger breadth. And particularly in the latter half of the year, we saw breadth indicators improving quite a bit. And we can see that the cumulative advanced decline lines for the New York Stock Exchange, for large caps, mid caps, and small caps all made new all-time highs in November, kind of right before the Thanksgiving holiday here in the US. They all pulled back in December, but look what's happened in January and now February. All four of these are still well below their late November peak. So none of these have made a new high, while the S&P and the NASDAQ have made new all-time highs. That's the bearish divergence. Now, I would argue, look for the lines in the sand for these particular breadth indicators. For each one of these, I've identified that swing low and put a horizontal line. So for example, for the cumulative advanced decline line on the NYSE, it's around 18,700, et cetera, et cetera. I wouldn't pay too much attention to the meaning of these exact levels because it's all based on advanced decline data and how that data has evolved over time. But these numbers are the numbers you could put into the alert engine. So you could say, tell me when this small cap AD line breaks below 4,100, and that would confirm a breakdown on the chart. All of these advanced decline lines are tickerized, meaning they have a ticker on the StockCharts platform. Down here at the bottom, you can see the large cap, mid cap, and small cap tickers that I'm using. And up here at the top, you can see the common stock only NYSE advanced decline line, which is the main one that I would use. So I would set an alert to tell me when is the advanced decline line, and you can set it on multiple ones if you like. When is this one breaking to a new low, undercutting that January low? And similar to what we talked about on that newer Dow theory chart, when these stocks or these breadth indicators break down, what that would tell you is they are breaking their line in the sand. By the way, I wouldn't be surprised if they happen at different times. So the S&P could break down while these breadth indicators are still above their January lows, because that could mean the Magnificent Seven stocks continue to accelerate lower. Think of like Tesla and Amazon and others that have really started to break down recently. If they continue to roll over, the benchmarks could pull back while the breadth line still remains strong because other sectors, value sectors, defensive sectors are still holding up okay. So that is true that you could see different behavior from these different indexes depending on how they're weighted and what stocks they're looking at. But I would say if and when any of these advanced decline lines start to break below their January lows, using the pink horizontal lines that I've indicated, for me, that would represent a confirmed bearish signal from a classic measure of market breadth. All right, now the final way that I think you can use the line in the sand technique, of course, is with individual stocks. And this is an exercise I do anytime I have a position on an individual equity. I have a whole chart list just to track stocks in a brokerage account or in a portfolio that I manage. And anytime I do, I draw horizontal lines just like this with my line in the sand. This is the level below which I will start unwinding this position because it tells me that it's no longer working, right? So on the chart of Amazon, I would say we've just recently broken down through a key line in the sand. The November swing high which is right about here, lines up very well with the early January low, and that's when the Amazon pulled back to test an ascending 50-day moving average. But then we can see after making a new all-time high above 240 early February, we then rotated lower, and the entire month of February has been pretty rough for Amazon as we've trended lower. We've had lower lows, price lows on most days so far this month. We've undercut the 50-day moving average and undercut that line in the sand. So I actually did have an alert set for when we broke below 216. That's now been triggered. And now the question's what's next. So what's interesting is on Tuesday, as we're recording the video, we actually had what's called a hammer candle. Let me change it into a candle chart so you can see what I mean here. We talked about this on my market recap show today. A hammer candle is when you have a downtrend, you have an open, you trade much lower, you close back at the highs. That usually means short-term strength. That usually means the next 1 to 3 bars are probably going to be higher rather than lower. So a couple things, a couple alerts that I might set here. Number one, I would set an alert for when Amazon breaks above 216, gets back above that breakdown level. We saw that with the S&P 500 last month, I think it was, right? Where were we? Here. In January, we broke briefly below 58.50, but then rallied back up. So once we break below, it's like, well, tell me if we get back above that level, because maybe that means it was a false breakdown. So I would set one alert for Amazon getting back above 216, maybe 217. The other thing I would do is take the low of today's candle, which is right around 204, and set an alert for a break below 204, because this hammer candle basically suggests short-term strength. But if and when we would break below today's low, that would negate the bullish sentiment in today's candle and suggest further deterioration, maybe the 200-day moving average, maybe even worse. So that is how I use what I call the line in the sand technique. It's simply setting price alerts based on key levels on the chart. But remember, the process is analyze the chart, focus on a key level, particularly with some of these other indicators like the Dow theory, like breadth indicators, even with the S&P itself. A break of what level would tell you that the picture is changing, that we've seen a change of character compelling you to take action. Set an alert with that particular level. Make sure you put a note in the alert engine to remind you, here's why I think this is an important level to follow. And then sit back and go do something else with your time and let the platform tell you with a mobile alert, with a big banner on the page, with your email, that something is happening that you need to take action on. Only by setting ourselves up with an exit strategy today can we make sure we minimize the opportunity for climactic loss in our portfolio tomorrow. I hope this was a helpful exercise talking about some of the key levels I'm seeing in the S&P, some breadth and macro indicators, also individual stocks, how we can use the alert functionality on StockCharts to get ahead of some of those moves and just make sure we don't miss any key moves on key charts that we're following. If you have questions on what I talked about, anything that I missed that you think you would have included in today's discussion, make sure you drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Have a great week, and remember, it's always a good time to own good charts.